All right, welcome back. If you've been watching the last few episodes, you'll know that we've been tracking something building and it's starting to take shape. Today, we're taking a moment. Today, we're taking a moment and taking a look at something that could genuinely flip the script on the way that markets operate. Now, I don't say that lightly. You know that I'm not about the doom and gloom stuff, but with the institutional fund managers bailing out of US equities at record levels and retail investors doubling down, while at the same time we're seeing serious chatter about 24-hour trading, institutional adaptation, and crypto-infused finance, we could be heading towards a breaking point, but not panic. Don't panic. This isn't about panic. This is about pressure, and it's about putting pressure on the institutions to adapt, or GTFO, get out of the way. More on that in a moment, because we also want to remind people just joining us, thank you for being here, seeing the chat box buzzing, that we are a technical analysis channel. This is one of the charts I'll be looking at this evening. Of course, as well, we are always interested on the show in the performance of US equities. We'll be doing analysis on SPX during today's show as well. Big shout out to XD, who just contributed to the goal. We have a goal this evening. It's going to be that if we can get to this goal, I'll start putting in the initial groundwork on making a Rocky website. I think people out there would like a Rocky website, so that's the goal this evening. So it's a goal. It's a goal. If we can make it, then I'll start looking into how to do that. But I want to start here with the discussion this evening. Thanks very much for joining me, by the way, folks. Really, always love having you here to do this. We have a weekly show where we raise the standards when it comes to financial, technical analysis, trading, and economic literacy, and it really works. And if you're just joining us for the first time, be sure to hit that bell button so that you get reminded the next time we go live on the show here. So there's a figure, $67 billion. $67 billion. That I want to talk about first. And I think this is an important number for us right now, because if you remember the show last week, we talked about big numbers in that show as well, to do with fund managers, if you remember. So 67 billion, that is how much retail investors, that's you and me, folks, we're the retail market, as opposed to the big Citadels and State Street Citibanks and all the rest of them that are out there. 67 billion, that's how much the retails are put into the US stocks this year. That's 2025. This is us just in March. And that's only just a little bit under the 71 billion that they poured in during Q4 of last year. Right? And this is, despite the fact that we've got people having to do taxes and everything else. And this is despite the market volatility, which I think says something really quite strong. We've been talking about SPX over the last wee while. Just a quick reminder for folks, this is the 4-hour time frame. And we can see that in this year, like February, just so much pain that's happened on SPX in February. It's the biggest drop that there's been in such a long time, and this has really scared off institutional investors, and that's what we spoke about last week, folks. But $67 billion is what we have put into US equities in 2025, which is pretty remarkable. And this is also despite the tariffs, right? So you had the volatility, and then you've got the tariffs. People know that the cost of living is going up. It could cause inflation, etc. What are they doing? They're putting money into equities. And this is despite tech corrections as well, and the market itself being in a correction. So meanwhile, the fund managers tracked by Bank of America that we spoke about last week made the biggest ever cut to their US equity allocations in March, right? So the two things are slightly juxtaposed. You have retail pushing one way and the institutions pushing another. And it's in this tectonic shift that all hell can break out. And it's not just a little bit of divergence, right? It's not just a little bit of divergence. You know, what I'm talking about here today is an actual split in the narrative, a real split in the narrative that's measured in hard data, not just in terms of like talking about particular stocks, like for instance, GameStop. And we'll talk about GameStop as well this evening as part of today's show. So stay tuned for that. They've just started to get involved in crypto in a big way, it looks like. So there's a split in the narrative, right? And it's more kind of data driven, this conversation, than anything that really we've seen in the last several years. So are we going to see possibly an epic retail was right moment? Or is this actually the final stage of irrational exuberance before the hammer drops? Because this is the question, and all hell will break out one way or the other. And when you've got this tectonic shift happening, then it looks like it's institutions versus us. And we're the ones that are actually pushing the markets up, and the institutions are the ones that are causing the markets to dip. What happened this time around is that retail traders screamed at each other, buy the dip. And that's not what institutions expected, not in the current climate. And actually, they've been caught offside again, possibly, with this. What could actually be happening here is that the institutions essentially tried to dump the market right down at your expense in order to do a transferal of wealth away from your pockets and into theirs. And normally it works like a charm. And it could be that this time, thanks to the type of analysis that we've been looking at, we're actually looking at this around the curve, ahead of the curve. We're looking ahead of the curve here. It's what we do in the show every week. Hit the like button. But people will maybe catch on to this story later. And this is something that we love to do on the channel here, is to bring the story early. And if you look back at the back catalogue of videos, you'll see a lot of stories coming out here early, very early. In fact, shout out to myself, who called Sam Bankman-Fried very much, at least 18 months before anybody else presented evidence and talked about it. And it's like, well, there you go. Nobody even knew. Anyway, that's what we do on the channel here. And what we're really seeing in terms of this possible retail was right moment is like tension building up in the markets, tension, pressure building. And the thing about retail is, and the institutions can scoff at us from their ivory towers. Retail behaves in a somewhat kind of herd mentality, blind ignorance sort of a way at times, and that has led to retail being caught on the wrong side of markets so many times in the past with such great financial pain. But could it be that this time there's been such, it's historic, it's the biggest ever single drawdown from fund managers in the last month, March, like in March here, we're still in March. It's big stuff. So could that be happening? And that's what I want to explore today. Either way, somebody's wrong. Either way, right? And when someone's wrong at this scale, something breaks. This is SPX, right? And today we have seen some drawdown on the SPX. This is the 4-hour time frame. Today started off with a bit of a drop, and where that drop took prices down to was to this gap. And this is something that can normally cause a bit of fear in the markets. And this is part of the story that I'm trying to explore today, is like, how even is that fear landing with the markets, right? And who are the markets right now? If during March the market was being dumped by fund managers, but money from retail was flooding into it, people buying the dip, who is the market? So normally when you talk about the market, there's this vague anthropomorphized word we're giving it a personality, but it's really just a nebulous thing. And now maybe we're able to look like left and right and say, hey buddy, we're the market right now, which is interesting. So the market's come back down here towards this area, the market being us, which is for the first time in history. Well done everybody, well done retail. And it's pulled back a bit today, and it's found this kind of made this bit of a doji on the charts here, this little kind of tiny little smidge for the 4 hour at the end of the day, and it closed leaving that gap on there. It is a threat, it is a threat that there's here, but this before was a bit of a breakaway gap. We spoke about the SPX chart last week, of course, and we remember that this was the resistance in around about that 236, and we were actually saying, hey, we think that things could go quite well. We were interrupted for a bit of a week, at the start of it. This was last week, or a couple of weeks ago. And the following day after my show, it dropped back down and it corrected a little bit. But we came back in last week and we spoke about this continued looking for this to actually continue doing what it was doing. All of this was identified in advance as possibilities and what we were looking to try and buy at. And then we were saying it was consolidating here as an area of resistance, and it could push up, but it pushed up a little bit too much, right? Bit of a breakaway gap, come back down, and we've been trying to fill in this gap here. And one of the things about this type of technical entity of gaps is that it's a really visual representation of testing in the market, because when you leave a big white space on your chart, there's a candle, there's a white space, and there's another candle up above. That draws everybody's attention to it and says, well, let's test that. Was there a bit of a shift in narrative at that point, shift in attitude, shift in sentiment? Let's see if it holds, if price drops down there. And that's kind of the proactive way of thinking about it. A lot of people would be reactive and saying, well, price has moved up a lot, they could correct back down, I'll wait and see if other people buy at the same time as me. And that's kind of, these two things drive that test at that time. And seeing it on the chart there while we're talking about this sort of story, it's a nice little kind of confirmation that if things are happening, that they're happening in a way where there's a bit of a test happening with it. So, it's not ideal in terms of today being a red day for people, and all the SPX sort of long side traders today will have had a bit of a tough time. But it, from a kind of broader perspective of pushing up, testing things, and then if you get continuation afterwards, it kind of starts to catch people more and more off guard, and that momentum that builds as those who bought were proven right to have bought, and those who are shorting against it are proven wrong. But there's a give and take during it, and it creates this organic layering effect where people get caught offside a bit, caught offside, and the other ones are getting proven right. I mean, that doesn't happen with retail very often, and it could be really great to see that happen in a moment when things are starting to rear their head. And I want to see how that impacts the story as we go forward, because I'm obviously talking about this in advance, but I do have the receipts as well, so we'll be looking at some more of the detail on that in today's show as we take a look at kind of, who's buying what and what that tells us. That's all coming up. So we're going to be changing the clock. In the UK, we're changing the clock soon. It's actually at the end of March, and in the US, you've already changed your clock, which makes this show a little bit later than it normally would be. And I appreciate people for tuning in. I'm just sticking to my UK scheduling, which makes it look to a US audience like, oh, Rocky's schedule's gone off. It's the clock change, and we're going to be okay next week. Okay, folks. But I'm talking about not my clock and your clock. I'm talking about the market clock. And this is where it gets even more interesting, folks, right? And this is the part that nobody is talking about yet. It's just you're hearing it here first, and ain't nobody else out there in the market talking about it. So it'll be interesting to see if somebody else does. So we've got commodity firms and trading houses. We're talking about Trafigura, Vital, Governor, CCI, openly discussing changing their operating hours just to match the chaos that's caused by Trump's tweet-driven policy swings, and that's kind of the iceberg theory, right? You've got an iceberg of reasons why they might change their trading hours, and at the very top of it, there's this discussion point to do with like how Trump will tweet something at Saturday at 11 p.m. and markets are like, oh, we can't respond to that now. Another effect is happening in Europe where they think to themselves, well, let's not bother trading in the morning because we're ahead of you in time. Let's wait for Trump to wake up and see what he tweets as he's having his breakfast before we decide what way the market's going today. And people are getting fed up of this. But that's just the tip of the iceberg, though. There's like the years now of data that we've got coming in from crypto. We've also got the shift in kind of policy and strategy in the US with regards to crypto, and that's getting built into the markets. We're seeing ETFs being launched. One of the things we'll talk about today's show is the Solana ETFs that are coming up, the ones that have just released, the fact that you can trade futures for Solana on the Chicago Mercantile Exchange, which is like big news in the crypto world. It's all kind of, happening. And we're seeing as well that the CBOE is starting to get involved in touting for some 24-hour trading. And it's just kind of, it's just sort of happening. So we had somebody from the FT, the Financial Times Commodities Summit, recently talk about this, and they said, you just wait for President Trump to wake up and decide how your day is going to go. And that's the European attitude right now. So like, just let that sink in for a second, that multi-billion-dollar firms are saying, we can't run our strategies like this anymore. So we're considering working until midnight just to stay ahead. And what the idea, that one of the proposals is to change the trading hours to 2 p.m. to midnight, right? And when you start doing things like changing from 2 p.m. to midnight, you're just a stone's throw away from 24-hour trading. Because all it takes is for some sensible European person to say, but what about my day? I still want to trade in the morning. And they're like, oh yeah, we have to. So actually it's 9 a.m. till midnight. And then they say, well, why stop at midnight? Just, it's a stone's throw away. So, and it changes the discussion an awful lot, because, it's no longer just about volatility, right? One of the conversations that you have when looking at these sorts of things is how there could be volatility if markets are a bit thinner. So since we're going to be talking about this product later on, I'll just use it as an example, is the Sol futures. And you can see that here's a market that has some time that it takes off. It's not 24 hours a day, and that creates gaps, but also it's a less traded product. It's brand new. It's brand new, this thing, brand new. Only started trading extremely recently. This is a 4-hour time frame, and that's all you're getting, right? Here's your weekly chart. And when markets are fairly new and illiquid, then you'll see things on them like kind of a bit scattered pricing. And this is the type of volatility when they talk about it at nighttime or different hours of trading. This is often the type of volatility that they want to avoid. A trade happening at $138, and then the next trade that happens is at $141, just with one single exchange, and obviously between people, and that's massive spreads at the time, totally inefficient market. And it's just that's one of the main things that they want to avoid. But it's not just about talking about avoiding volatility or what's the right times or condensing things. It's also just talking about the practicalities about how these fundamental shifts that can happen at the wrong time of the day. So when I say the iceberg, there's an iceberg of reasons why they might change, and at the top of the iceberg, there's the visible conversation, and this allows the visible conversation to happen. But there's 100 million other reasons they might want to do this, and this makes it so it's possible to talk about it, because it's no longer about volatility. It changes the conversation, and that fits a pattern that we have been covering, where the clock itself is becoming the battleground, because markets want to run 24/7, and President Trump runs 24/7, often leaving certain things until after US markets have closed, and much after European markets have closed. And indeed, Europe is stepping up and challenging that reserve currency status. And we see foreign markets also expanding. And this, in the one side of things, paints a picture of a slightly shrinking dominance of the US. And that could be one of the main fundamental bullwhips, figuratively and literally, that gets the market moving towards the top side, when the cascade of realization of these different factors dawns on decision makers. And that's where you can see a story kind of building out around this. So what would be the first port of call that they would go to? And stable coins, right? Stable coins, because they're stable. That's the first. You can make money doing stable coins. Just for example, say someone said, I have a stable coin, there's 1 million of them and they're worth $1 each. You can only have them if you give me $1, and they're backed 1-to-1 by dollars. You think there's no money there. But what happens is they take that money and they buy treasury bonds, and then they have more dollars as a result, and then they sell those to people. And the whole time it's just people coming in, giving them money for something, and then buying more bonds, and then them selling more of it to get more money to put into more bonds. And you know, as you go through that growth phase, you have that kind of Ponzi element. It's not Ponzi, where the more customers coming in just makes everything grow, because you're buying these bonds that have got growth on them. So there's a growth thing there that happens there. And if you have volume and scale, you can make an awful lot of money. But they're not for making money, essentially. But they're not for losing money, right? And they're not for just breaking even either. Okay, not really. There's more to it than that. And Fidelity is planning to launch its own stable coin. So Fidelity is openly talking about the plans that it has to launch a stable coin, and Trump is backing a separate one, right? It's well discussed as well right now in the world that there's another one that Trump is backing, Trump's family as well. And Washington is racing to finalize legislation that could cement stablecoins as institutional cash alternatives. So, you know, they're liquid assets on the books. And this isn't just crypto hype. Fidelity is also working on a tokenized treasury fund. So you see how stablecoins work. Now, what if you were to take that and sell it to people? That would be a tokenized treasury fund, and you could absolutely make money from that as well. And they're not alone. BlackRock, right? Franklin Templeton and Custodia are all moving into tokenized cash equivalents, and that changes the game. Imagine a world where retail investors get 24/7 access to regulated tokenized dollar assets, while institutions are still stuck chasing alpha in delayed, fragmented markets, especially if they're stuck in the mud and they're slow to change. And we're seeing that retail is screaming by the dip in the markets, which signals that retail has kind of got a slightly different, more refined approach, perhaps. And that's not just disruptive, okay? This is an inversion of control. And then all hell would break loose. Am I right? So if retail is on the right side of this shift, yeah, yeah. You know, because like I said, somebody's got to be wrong, okay? And if the ones who are wrong is retail, then, well, we've lived that story before, haven't we? You know, a different type of all hell, a bad all hell, broke loose back in 2008 and various other times. So we know what that is like, but they don't know what the other type of hell is like, and that could break loose. Imagine hell broke loose in the other direction. So more details on that later on in the show. So it'd be good if perhaps I brought up something like a filing from Fidelity or something like that, show you exactly how this one's new structure might work or something like that. But that's something to think about. We're 4 out of 30 towards the goal, folks, and the goal is important. I don't want everybody to forget about the goal. The goal is important. What we want is to be able to have a website. This would be a bad example of a website. I suppose. Would this be a better example of a website? Yeah, so we could have a website. Here's an example of a website. What do we see on this one? NASDAQ is going to go 24/5 in 2026, and brokers are getting ready. So the financial trading markets are set for dramatic change after NASDAQ's president announced the plans to extend the working hours to 24 hours, 5 days a week. And when did this article come out? Well, that was on the 25th of March, 2025. And you can see this means that this trending topic is now really current. This is the trending topic. This is a kind of one of the big boys getting in on the mix. They're not the only things to be doing that, because we've got the SEC approving the first 24-hour stock exchange, which was published in November 28th of 2024. So you can see how from Q4 2024 to Q1 2025, this topic has gone from the SEC approving first 24-hour stock exchange to some of the other big ones saying, well, we're going to do it too. And you can see that this chart is trending up. So you can see the story that I'm putting together here clearly in advance of anyone else in the world even thinking about it is actually starting to explain itself. The Securities and Exchange Commission has approved the first round, the clock stock exchange in the US, signaling a major shift in traditional trading hours. 24 exchange, 24X, backed by Steve Cohen's Point72 Ventures, received regulatory approval for a 2-phase implementation plan, right? Cray. So, is it the only ones? Oh, look, the CBOE are going to launch 24-hour US equities trading. This was on the February the 3rd of 2025. And you can see, right, this is a topic of conversation that's coming up frequently, but just enough in the background for you to not necessarily take it seriously and see how this is all building together. And it happens to be happening at a time when all these big institutions are taking their money out of markets. And the president is the economy president, right? The economy president, basically. Like, if there's one thing that you can say the world expects from Trump administration, is that there'll be periods of extreme bullishness in markets. Would that not be a fair statement to make? I think that's a fair statement. I don't want to, if I'm wrong, correct me in the chat box there, but I think, or leave a comment down below this video if you're watching it later and tell me what people actually thought would happen before. I think that was pretty much what everybody thinks. So this is all lining up. That would be the ones that retail are the ones that have already got their accounts are in the green. And that would be mental, wouldn't it? Or it could flip the other way, of course. And we know the way that it's gone in the past. And this is the 15-minute chart for SPX. I do think that there's a strong chance that we come back down and test and actually fill in that gap. Okay, so yes, prices were kind of more or less defending the gap on the 4-hour time frame, as I showed you at this, earlier on in the show. But there is a flash there, and you can see that being tested. The way to handle this, though, of course, will be to look and see how things are actually going in the opening hours of futures, perhaps before markets actually open up, which you can do using ES1 !, which is the SPX S&P 500 E-mini futures, and you can see the prices are more or less the same, kind of, so you'll recognize them. And if this said 6,000 tomorrow, then you would know, right? Okay, so it's quite simple to do this sort of thing, and this can give you a bit of insight as to how things are going. So obviously I'll be looking and asking questions then with regards to that gap. I'll just remind folks, SPX, you maybe didn't see it, you might not have seen it. I'll just draw a box over the gap here. So here is the gap. It's a big black box, so you can't miss it. Right there, censored. I'll just make this see-throughable now so that you can kind of see. So that's where the gap is, and the prices have actually made it into the gap. Thank you, Lisa. Thanks for another great stream, Rocky, says Lisa in the chat box. That's awesome. Thank you so much. Hit the like button on that chat if you're seeing that in there. So what do we see on the ES chart? I'll just draw the box where it is. So you can see the gaps. This is a different place, and this is one of the ways that you might get some ideas about how things are going. So anyway, Rocky Outcrop, this is the channel here. This is the Rocky Outcrop show. We do these shows every week. I actually have a Discord which I invite you to join. In fact, I'll put a link in the chat box right now as we're talking about this, so you can join it. You just have to click the link. It opens up Discord. It's an invite, so the app automatically takes you to the login thing. And you can join that for free. It's pinned in the chat now. You should do that. You should be a part of this community. We do great technical analysis. We give people kind of the information that they need. We'll be doing technical analysis, by the way, on crypto and in the show today as well. And this is a request show. So if you're just watching this for the first time and thinking, oh, would this guy be able to give me some insight on what it is that you are investing in, then yes, I could do that for you. So get in touch with the links in the description. Okie dokie. Thanks as well to Donna Bell for the tip there a minute ago. Rocky, see the whole of the moon. Thank you so much. Hopefully I don't go too far too soon, but I certainly do see the whole of the moon. Thanks so much for that. So yeah, that is how I'd be looking at SPX. I think that there's possibly the chance of the markets going back down to test that gap there. I would be looking at the pre-markets to see if that's how that'd be going. And then over the next wee while, what I'm looking to see is can it actually maintain action above that 236. So I'll just remind people what that was about. And then hopefully we can go on for the rest of our targets. So we've laid out these things as well. If you want really detailed technical analysis with regards to possible targets and so on into the any sort of retracement back up here, then I have covered these in the past. But what I'm looking to is if we come back down and come into this area where the grey box is, that we can stay above this orange kind of line just here, because that's where the 236 is. So essentially, in terms of numbers, if SPX is kind of able to maintain prices roughly above 5,650, then I'll remain fairly bullish on this so far. And while I might have a bit of a tolerance for volatility, such as moves down to 5,555, 5,555, I would be tempted to cut my trades at any sort of close below 5,500, to be honest, more or less there. Be willing to do that. I could always open up the trade again if I was proven to be too tight on my risk management. But I think in a situation like this where we're betting against the big boys, because that's the story as well. We'll be talking about this for a while. We're betting against the big boys here, guys, So there's no point in pretending that we're not, like things have been bearish, right? And that's why things have gone down in price, and we've been really patient and waiting for good entries on this one, and now we're going to then remember to also manage our risk, and in the long run we'll beat the institutions by doing things the right way. I'm not a financial advisor, none of this financial advice, by the way, but we'll just use good practice techniques, and we'll be coming back to do more technical analysis shortly. Just wanted to ask you though in the audience, what do you think about 24-hour trading? Would you do 24-hour trading? Put a message in the live chat box if you're doing that now. I'd love to see if anybody is watching this audience who's doing that now. That's cool. But what do you feel about it? And if you're watching the show after as a recording, put a comment down below and let me know what you think about that, and if it would see all hell breaking out. Because the obvious thing that I'm talking about is if retail is going to work at the cheese sandwich factories and coming home tired after a day in the real world, and these guys in their ivory towers are sitting there from 9 to 5 going, yeah, we can beat these retail guys, we can beat them anytime we like. But of course they don't have to go to the cheese sandwich factories. Then maybe if these guys came back and had actual trading hours accessible to them, we might even see all hell breaking out, right? We might. So let me know what your opinion is about that. So if institutions anyway are struggling to keep up with Trump's policy cycle in real time, what's already changing. And we have seen interactive platforms like Moomoo, Robinhood have started offering 24-hour trading windows for select US stocks. And one of them is GameStop, isn't it? Right. So we'll talk about GameStop, I think, in today's show. Let me know in the chat box if you want to talk about that. If anybody wants to request analysis on it, we could do that too. But let's just leave it up to the chat box. And it's not talking about futures either. It's not talking about crypto. We're actually talking about actual equities here, and that's what you're buying and selling on these other platforms already, 24 hours. So it's already happening. So the idea is then, if information never sleeps, right? If information never sleeps and the sun is always shining somewhere on planet Earth, why should the markets sleep? They don't even have breakfast, and they don't need to wee, and they certainly don't need to sleep for most of the day as well. So how about we kind of change things up there? Now, combine that with platforms letting retail trade fractional shares, yeah, and then instant settlement models, tokenized assets, stable coins, as we already spoke about. They're bringing in legislation and stuff to allow these to act like institutional cash, just the same thing, this digital stablecoin functioning just like we spoke about that earlier on the show. You see, when all these things start to fit together, you start to get a picture of how the old market structure is fragmenting, and institutions that don't adapt might end up stuck in narrower, lower liquidity channels. And the more agile, faster participants, including retail, get first mover advantage. So we can talk more about these stocks. Let me know as well in the chat box if you want to know like what stocks are getting 24-hour treatment. If that's something that you want to see me make content on and make a video about, for instance, leave a comment saying that in the box below. Of course, people who join the Discord are able to reach out to me directly and say, make a show about this. But it's cool if people do that in a public way, because if you said that below this video and then lots of other people saw it and hit the thumbs up button on that comment, then I'd be way more likely to do it than if just one person reached out to me directly. So think about that. And we do want to take let as well when we talk about these things. Okay, we want to be clear that there is a guiding data principle to what we're talking about, right? It's not just me telling stories, right? I mean, they're very good and well researched, and I work on these throughout the week and present that I think what's the best, most relevant information at the time every week to people. But there's actually hard data involved in this. It's technical analysis. We've already done some on the SPX. We can take a quick look at triple Qs. This would be some of the NASDAQ here. You can also, like I did with the ES stocks, look to the futures chart. And if you do give it the same treatment as what I gave the other one, you'll see the technical analysis story is actually the same here. So I was just drawing on another box. This is the 4-hour time frame, and we can see that we've come down here to test the area of this gap, but not bust through it just yet. And this is a big visual signal to the markets as to whether things would go positively or bearishly thereafter. You know, while things can go sideways, anything can happen in markets. You often see if prices come down here and then respond away from here, that it's become such a clear visual signal to people that this is quite bullish. And one of the things to look to, of course, is right there where there's that red box, which is a fair value gap, showing us that in this section, when the market's descended between these 2 points here, there's nothing testing that during that period of time. You know, it's just completely dropped down. And one of the top conversations that we have throughout these weeks has been that everything gets tested. Now, what's happened with the drop down here is, of course, that the previous entities on the chart that needed to be tested got tested. Okay, so actually there was a fair value gap in here, for example, that got then filled with this one. That does in a way kind of reduce the kind of significance of the fact that there's one here, because this was a drop down which had its own testing component about it. Nevertheless, it remains on the chart as an artifact, and it's something that we could be interested in if we see prices moving up, because if they move above 20,150, the chances of them running up towards 20,300 are quite high. And if that has positive news and so on associated with it, you can see things like that. Happening very quickly. But of course, the alternative to this story is if markets do then suddenly crash down through this area, then you could then see them go on to test other areas, such as this one just over here that does remain needing to be tested in some ways. The next area that you would look to would be down here, but with a story that has this long channel in it just here. If you were to see the markets come down to test in this area, the fact of the matter is that we would know that there'd be an awful lot of liquidity that had been built up in this zone, as people had thought, well, if it goes through here, I'll cancel my trade. So this would be how that would kind of look in terms of using the tool to do that instead of drawing a squiggly box. So all the people who have this type of mentality might start to be tested in that phase. So anyone who has a stop like this could be cut out. And who is it that gets punished with these types of trades? Well, if you were long from here and you had done the analysis to know, right, that there was a test at this price point and this price point and this price point, which you could actually manage your risk at, and you had a trade which was set up and you'd had gone up and you hadn't moved your stop up to this one, and you hadn't moved your stop up to this one, and you hadn't moved your stop up to this one, then by the time that the price actually came back down to this area and stopped you out, then the person who's done that has actually converted their incredible winning trade, which was anything from down here, which could have been anything like a 20-to-1 to a 4-to-1 risk to reward, whatever it is. They've converted it from that into a minus, or into a 0.4 to 1, into a crap trade. So that's why the markets often will find an awful lot of liquidity down there and punish those people, and afterwards not give two craps about the tears that they're spilling at the time, because that's cruel, right? But then the flip side of it is, what are you doing? And of course, that's why you see the markets moving up and oscillating down, up and down, up and down, because of the fear of that happening actually, and this is what is the back driver for markets. So that means that we can reduce this analysis down to a fairly broad, simple structure. Now that you understand what's going on here, I'll just draw that on. I'm using NASDAQ for this. Similar principles apply on the others as well. But you can see those two dotted lines I've just drawn around this chart here. And this does, of course, mean that this section could be considered to be, if we look at something like the daily time frame, a bear flag. And we spoke about this last week as well, but the story remains true. Just wanted people to know that why you would continue to manage your risk if we did see prices breaking down here at any of those levels would be because the analysis would suggest there's a highly likely chance it comes all the way down to any of these targets, and that's a different type of all hell breaking loose, and it's not a very nice one. It's not a very nice one. Okay, so nice, isn't it, the way that these things fit together? But it's always best not to overwhelm people with too much of that analysis. Pretty cool, though. Pretty cool. What you have got out of that section, by the way, is an understanding of the intimate detail of this recent upward price action on NASDAQ and an idea of where to position your main risk pivot points, depending on how long you are, in order to avoid any sort of pain that the prices might come down to, which would actually be where the best place to long would be where you were having to stop out. And this is why one of my phrases that people associate with me, I said it, I'm the only one that says it. I invented it, whatever. People who know me know that I say to put your entry where your stop is, and that's an example of that. But of course, the same applies on this story as well. And that if we come down and test this gap and find support and push on up, it would be a test of the lower end of what could be considered a channel when we kind of look at it a bit closer, and it could be the next buy the dip opportunity, and that could be what's happened today. I'll show you what that looks like real quick. So this is the bit of a channel just here that we've had going up, tested already. Any movement up from here could be considered a buy the dip opportunity. What we have above us is a complete lack of liquidity, so cases could move quickly, and that's the story I'm telling you. It's interesting, isn't it? It's interesting. That's how analysis works in advance. We're predicting the future there, and we're doing it using risk management, knowing that we can predict any sort of story about the upside got a pretty good one though, pretty accurate, and we can but it doesn't really matter that much to us because we know how to manage our risk, and our only story that we actually care about is this box for managing our risk, right? And that's how technical analysis and a risk managed approach to trading can make you money. Cool, eh? Thanks for the donation, Sauce. We got in the chat box there. I'll just hit like on that one. Thank you so much, mate. 24-hour trading equals no more dark pools. And he's just catching up with the show. Welcome. Yeah, it certainly changes the game. One of the main things, the main reasons why America has got the shortest trading hours for traditional US equities anywhere in the world, their one is so condensed. They don't get out of their bed until late after everybody else. In terms of, the UK markets open earlier in the day for the UK. They get out of their beds earlier. You know how it's different time zones? That's not what I'm talking about. I'm talking about how earlier in the day the UK markets open, and later they stay at work for longer and they close later, and that's standard. The US ones are condensed, and it's not to do with like wanting to have a lie-in in the morning, although that is a wonderful cherry on top. And it's not about just being able to get home to your family earlier in the evening. Another amazing cherry, I guess, on the bottom there. The reason they do that is to condense the market hours down as much as possible in order to reduce volatility. It does actually increase volatility too, but the way they talk about it, reduce the market hours down as much as possible. That type of volatility I showed you on the chart when it was less liquid because it was new and things are a bit spotty. That's what they want to reduce. That's particular type of volatility. Even if those candles in the same time frames went to the same prices but actually traded in between, they would consider that a big win, even if the open and closing prices were the same. That type of volatility is why they've condensed the markets down to that time frame. So dark pools also address areas of liquidity, and the whole liquidity landscape and the whole trading game would change. And I don't want to make a grandiose prediction about how a really convoluted system, and it's convoluted not in order to put a barrier to entry to people, but because it's an incredibly complex modern thing that it wasn't created overnight. So I'm not going to say how the millions of different permutations of it would necessarily go. I've just boiled it down to a simple sentence, which is that if retail are making money right now, the institutions are losing money right now, and if retail are right and institutions are wrong, and it kind of is happening at the time when the institutions have had the most ever in history withdrawal of their exposure to US equities, at the same time as retail continuing this really high watermark for investing, it's extremely bullish, and those two things create a tectonic plate shift that all hell would break loose. And that's how I've summed it up. But we don't need to go into the details too much. The point really, I suppose, in some way is that if retail's buying into this weakness, right, and they are right, then institutions will have to chase. This is the implication. I don't know if this is clear. Sometimes it pays to fully, completely explain a story. I thought it was pretty obvious, but when I say this thing about if the retail's right and institutions are wrong and they're making money and they're ahead of game and they're in the green already, what I mean by that is like the next thing. And of course, you could keep going right down this rabbit hole, and I could keep explaining all night. So I'll just cut it at this next point. But the next point is that institutions would have to chase after retail, and that's a situation which you'd never really see. It's like January 2021 with GameStop, okay, except more kind of spread out across, just retail haven't become a niche area of a meme stock. Retail have advanced to now become the market itself, and this is when I'm talking about all hell breaking out loose, as opposed to a proportion of hell, a slice of it. No, I'm talking about all hell. That's what the title of the thumbnail says. And if they have to chase, that's when volatility would explode upwards, but it wouldn't be in fear, it'd be in forced re-entry. And all hell doesn't break loose on the way down sometimes. It doesn't always and have to be on the way down sometimes. And this could be maybe one of the few times in history it could break loose on the way up, and that is something that most people will never ever prepare for, which is why I'm talking about it with you today. And if you do get value from my videos, by the way, put a lot of effort into these things, want to make the best, want to make YouTube great again over here, my little corner of the world, trying to really up the level that you get in typical financial YouTube world, in FinTube, is that what we call ourselves? I don't know. I want to up that game for everybody, and this is sort of value that you get on the show. So if you're interested in that, then do, of course, hit the like button, hit the bell, come back for more. And it helps, by the way. If people leave comments down below, it really helps. Thanks so much to Merrick for helping push us towards our goal. We've only got, by the way, 5 minutes left on the goal. We're 7 out of 30 towards it. My audience must have made a heck of a lot less money than they should have done over the last week. My analysis is very good, but again, I'm not a financial advisor, so I suppose there's the quantified evidence of the fact that I'm truly not a financial advisor, and people are definitely still doing their own research. going by the anyway. So let's just recap what we've got so far, because I've spoken quite a bit today in today's show, right? Institutions are pulling out of US stocks at record pace. This is one piece of the pie. This is stuff that we've spoken about for quite a while on the show. It's been a cool story of building up to. And right now we've got a lot of gifts being given away to people by Shadow Leptin in the chat box. So thanks very much for gifting memberships to people. Right, so first one, institutions pulling out of the US stocks at a record price. We've also got retail are buying the dip with staggering confidence. We've also got people talking about trading hours being challenged by volatility and the president's tweets and so on. We've got Fidelity, Trump-backed groups, and Wall Street titans building stable coins and tokenized treasury vehicles. Right, we've got platforms. This is me onto the thumb now. We've got platforms already enabling 24/7 retail trading access, and this is not me just saying a bunch of noise. These are structural cracks in the old system. This is kind of what Gary Gensler was pushing back against for so long, wanting the world to catch up. He could see it was inevitable as he was the chair of the SEC, but he did hold back the tide just a little bit, and he kept saying, come on guys, like holding back everyone, come on institutions, come on, make something, do something, improve enough, because this is the inevitable. But he didn't think, and those flood walls could burst at some point, and who's going to be ready for it, right? Is it going to be the people in this audience who've watched this episode and who hit like on this video and then joined the Discord? Is it going to be them, or is it going to be other people? Well, I'm sitting here talking about it right now, so I think it will be us. But we'll also manage our risk and will not be caught offside, because all of the things that I say come with a risk management target on them, where you then say, I'm wrong until the price is back above that price point. Okay, this is how you do things. Had somebody reach out to me in the last YouTube video talking about how they got into LPSN at $1.30 and that they were upset at LPSN price now being below 90 cents. And it's like, I feel for you. And I did talk about, well, if this is how you're going to feel later, a couple of things. Never invest more than you can afford to lose, right? Don't do that with any investment. And number two, you make your own damn decisions, right? And I talk about risk management, I talk about what to do. So I also said to people that if it drops down below 120, it's going down at $1. It's highly likely that it tests lower, but where the good value prices would be to buy and sell at. And I said that anybody buying above 120 is selling it at 140. So I said everything around it, but I don't want to annoy that guy that's watching it. I'm just saying that I'm genuinely not a financial advisor, all right? I'm not. So don't treat me like one afterwards. But do put peeled grapes into my mouth and fan me with large palm leaves and give me feet massages. That's what you should do, though. So who's going to end up being the first to adopt 24-hour liquidity? Is it going to be retail, or is it going to be institutions? That's one of the big questions that I'm asking as the old world is starting to break up into these new pieces of a new world, and we're going to be the ones to put them back together, just like Humpty Dumpty, damn it. And they end up with direct access. Okay, who is it that takes that first 24 liquidity, and then will they be the ones that end up with the direct access to the tokenized cash faster? And then can they get that faster than institutions can regulate it? And what happens then? And does it actually start to pull at the threads of the fabric? Does SEC, does the worst nightmares that Gary Gensler could have had and woke up in the middle of the night with sweats turn out to come true? What happens next? Or is it just Lambos for everyone? Let me know. So tell me, right, in the comments what happens next, because at this point the disruption, it won't be retail versus Wall Street, right? Eventually what happens is with this type of thing, it becomes Wall Street versus itself, because it has to play catch up while the clocks keep ticking. And if the people at the head of the market are the retail, and it's all the institutions having to catch up, they have to stand on top of each other's heads to get up higher. And normally they stand on retail's head to get up higher, but they can't because their feet are way below us. Imagine that, right? And imagine what sort of hell would break out if that was the case. Thank you so much to Gartham for gifting 5 memberships. Thank you so much for Shadow Leptin, who has been a member for 44 months. If you're getting gifted a membership right now, then the thing to do is to renew that membership during this during the month, so that you can maintain it into next month, because a gifted membership only lasts for 1 month. Be sure as well to share this video with your friends and colleagues at work. They will love it. We're going to be taking a look here at Bitcoin and asking a question or two, such as is it just the greatest thing in the world, my technical analysis, or what? And if you're thinking maybe it's not the greatest thing in the world, it's probably because you're not a member of the Discord premium side where where I've been talking about cryptocurrency in the most amazing way. It has been good. No, it has been great. It is probably the best analysis and education that you can get on the topic. Why? Well, when I set out to do it, that's the goal I had in mind, and I didn't stop working at this until I could get somewhere close to it. And we talked about a few things over the last wee while. Like, one of the things that we talked about was prudent positivity. And another thing that we talked about was, let me just move this over a wee bit here. Let me just shrink this down and get something like that. Oh gosh. Oh, by the way, if in today's show people are watching along here and you're watching on Twitter right now, for instance, if you are, and this thing is what you're watching, then big wave to the Twitter people, then leave a comment down below this video and I will maybe later. Okay, that's cool. Thanks. So anyway, maybe then I will respond to any comments that come in here. So put a comment down below there and start a conversation and I will finish it. No, it won't. That almost sounds aggressive. So anyhow, this is the chat that we had recently with regards to the show, when I was talking about the grey lines and how they're resistance at that area. There was a pullback down here. Now on the 4-hour time frame, what we actually had was the first new flash that came up in quite some time here. So I was talking about that back last week, and how this could obviously be this could be where the prices are going next, and that becomes a concern if there's any breakdown below 86 grand at the minute, because this could become a little bit toppy. This section of price action, it has a little bit of a double top type M for murder could happen. Is it dialing M for murder? So the target on that would be, if it broke 86,000, you might be looking for it to go down to 81,500, and that is a fairly big move, and it's bearish. But we were talking about this last week and asking, can it actually sustain prices here at 83, which it did. And the reason why is because this was the first flash that we've seen in a long time on this time frame, and there was one down there, and there was one up here somewhere. Maybe not. And the impulse move up that came off the back of that was quite interesting. Now, there was a second flash, and I continued the conversation going. And I said about prudent positivity. And we're looking here at this price point around about 86 grand. and saying, well, if this could be tested, is that actually not a flash? Was I just confused about that? And it's just the no, it is. There was, yeah. It got filled in exactly. So there was a flash there, and I was asking in the Discord if that was going to be. Yeah, so if that were going to be testing that. So I was talking about two words recently, or two phrases that I've made up myself here. Prudently positive and responsibly responsive, because that was the summary at the end of the chat that I had about it. Some great posts from TradeSpotting in there as well. Shout out to TradeSpotting. So one of the things that I talked about in the premium side of Discord recently in the cryptocurrency room was this list of things. Bitcoin being above the volatility channel, its price was previously resisted at, the flash that happened previously and the one that just happened, Solana being traded on CME, the volatility during the period, the dynamics impacting the others market, which doesn't include Bitcoin, Ethereum, or Solana. It's an index of cryptocurrencies without the major players. The structure of price, which makes it a higher risk pivot, and an experienced trader mentality about how to be responsibly responsive by highlighting the difference between conflating proactive with front running a break. What did we see here is you were well advised not to be front running a break above this line, and to be positive prudently, and to be responsive to changes in the markets, but to do so in a responsible way. And we broke it all down so excellently. It's absolutely wonderful. Anyway, sustained prices up above that zone I was talking about, already highlighted the risk management for us on this chart and where the bearish side target would be, and actually looking to see if it can challenge and break out of this zone and push into the next one. The next high up target could be taking us up towards $99,000. That would be a massive psychological change in the market. It would obviously find resistance anyway at around about that line, because it is of course a nice big round number, so which makes it very easy to say that the next target would be about $100,000, and it just so happens to line up with where the next line would be. So when you see these kind of areas of confluence, it becomes very, 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 very compelling. I'll be looking to try and take advantage of that if we actually confirm above 90,000 for sure. But I'll be actually thinking about whether or not it is conflating being proactive with front running. If I was buying it above 89, actually that might be where the breakout is, depending on how momentum and stuff is playing out at the time, and other various factors of course. But that's how I'd be planning on trading this one over the next wee while. If that's too complicated for you, then don't worry about it. By the time, you'll be trading for life, right? Tune in here every week, learn a skill, you'll trade for life. It will absolutely radically improve your quality of living. Let's do this together. If you didn't understand that and you think you would like to, then let's make that happen for you. And if you do understand it, then pretty good, right? And if you don't agree, let me know why you don't agree in the comments down below. I'd be interested in hearing what it is that you're thinking about. Yeah, I didn't overcomplicate it with a mixture of indicators. Yeah, I used just like 2 ingredients to make that whole thing work, right? You've got the Rocky Outcrop Flash, and you've got price structure itself. Just 2 ingredients, just a bit of salt and olive oil. That's all it was to make the tastiest roast chicken you've ever eaten, except it wasn't roast chicken. It was money, and it wasn't salt and olive oil. It was technical analysis and risk management, but you get the point. And that was very, very simple. I can make it a hell of a lot more complicated than that. But if you're thinking, hey, this is good, he chose the right things to tell us, then you found your home for trading. Welcome to the family. Thanks for joining us for today's show. It's awesome to have you here. So that's the Bitcoin stuff that I want to talk about. And I wanted to mention to people as well, there has been a couple of developments with regards to Bitcoin recently. So if for all the Bitcoin and crypto traders out there who are watching right now, if you trade BTCUSDT, or you trade Ethereum, or you trade if you trade XRP, I'm trying to act like a nerd there. Oh no, not a nerd, like an idiot. You'll be thinking to yourself, we're so degen. There's nobody that can be more degen than us. And you are right. But there is an interesting community out there who are possibly kind of like a close second, I suppose, in a way. And the thing is, they're now coming over to actually get involved in crypto for the first time. Yeah, so if you've watched my channel for a while, you know that I've been harping on about this for so long. It's like Ryan Cohen waited for this long just to prove to everybody that he didn't watch my videos. That's what it's like. It's that level of like thing, because I've been talking about this in so much detail. Anyway, GameStop stock, I just made the mistake, everybody, rose nearly 15% on Wednesday as the company approved a plan to buy Bitcoin with its cash holdings, except actually that's a misinterpretation, because there is this news that again came out today, which is that instead of doing it like with their cash holdings, they're just going to take another $1.3 billion off of people. So we're not actually sure what the details are on this yet, and I'm sure the story will come out in the wash and we'll figure it all out in the community. So if you're thinking about how you want to be involved in the community and whether or not there is a space for you as a GameStop trader, then you might want to be involved in the GameStop room, which is there's the conversation. I made a conversation in just this one room since I posted earlier on, just an hour or two before I started my show. So even though I'm on live and most of them are here watching us, there you go. It's somebody's chatting in there right now. Look at that, TradeSpawn chatting in there right now. So as you can see, it's the place to be. We can figure this all out together. But I'd kind of put a question mark. I would put a question mark over whether or not it's actually going to do it with its cash holdings. That's not quite clear yet, but it could be. It's just that I think that a lot of them are wrapped up in treasury bonds and stuff like that too. The video game operator, and somebody said in the Discord, let's just find the comment, shouldn't I, actually? Somebody said in the Discord, because you know what it's like if you've been a GameStop holder, you've been dying to hear about a plan, you've been planning to hear about a plan. There's me talking about Ryan Cohen ratioing Jim Cramer with his tweet earlier on. That was funny. I think it's so funny the way that Ryan Cohen is like a sort of dweeb retail investor putting tweets like that out there. He's a CEO, a billionaire CEO, and he's putting out tweets like that. It's just funny, isn't it? It's cute, it's funny. And we were talking about the thing, what did I want to say? I'm only looking for like a pun. Here we have it. Had to scroll back quite a bit just to get to last night. And this is just one of the many rooms in the Discord, by the way. Really healthy chat, by the way. No asshats at all. And you might be thinking, oh, you mean they're all really cool? Like, what? No. There's no. And now you're thinking he doesn't mean an actual, really genuinely cool community full of actual, really decent people. Nobody, and it's actually really good. Yes. That's what I'm talking about. None. There's none at all. That is freaking amazing, right? Amazing. So if you see yourself on screen right now, that's pretty good because I'm giving you a compliment, I suppose, haven't I? Anyhow, this guy is said, are we sure they have a plan in the works? Big shout out to you, Meccan wee buddy. And I said, maybe it isn't a plan. Maybe it's a micro strategy. Good lols in there, right? So they're micro strategy, and you can see the micro strategy kind of coming into a bit more fruition here today, which is actually what I had in mind when I said that. Oh, it's just a pun. No, it was me saying that what they're probably going to do is actually raise money by offering convertible notes to people and get $1 billion and put that into GameStop, and it's not actually a plan for the thing at all. We also, if we look up higher, we can see that there was good chat before about whether or not the earnings would be positive or negative. Great chat in here from people about that. And I'd started off as well, or I didn't start, I don't want to claim credit. Other people started off the chat about the earnings, I guess, probably. But I put in some great chat about, do we think they'll be better or worse? And to be honest, everybody in the retail, in the GameStop space thought they'd be actually worse. Right, and I was asking that question for the first time in a few quarters because I thought there was a chance they might be better. Obviously, their headline, revenue figure will be down. That was kind of the known thing. It was a question of whether or not they'd be better. So yeah, there's your news on the GameStop front. And as a result of that disheartening news to the retail investors, the stock absolutely plummeted after people found out, went down from $30 to $25, and everybody is really, really, really annoyed again at the dweeb that put out, this comment yesterday. Let's be honest about this, right? Because this is what happens, okay? So you have this happen. Jim Cramer says, GameStop is finally doing my Bitcoin ploy. And everyone's like, oh no. Because Jim Cramer, inverse Jim Cramer, and every time Jim Cramer says something, a stock dumps, and ha 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 ha, and then he says, no, ha 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 ha, no Jim Cramer, you're going to dump our stock, Jim Cramer. Oh no, ha ha, no Jim Cramer, don't dump our stock, Jim Cramer. You're dumping our stock, Jim. It's your fault, Jim. It's your fault. It's your fault, Jim. It's your fault. Got a little bit of news for people, but don't forget it's Jim Cramer's fault. We're going to dilute by the people by $1.3 billion. It's not it, but it's Jim Cramer's fault. It's Jim Cramer's fault. No, no, Jim Cramer, don't do it to us. $1.3 billion in convertible senior notes, private offering aimed at qualified institutional buyers. It's like, beep, 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 beep. Hello, we are qualified institutional buyer. Hi there, I'm Ryan. How can we help you today, Ryan? I was just wondering if you put some money into my Bitcoin plan. We thought you already had $5 billion in the bank, Ryan. What do you want us to do to put money in? Why do you want us to put money into that? I just thought it'd be better to do it than that, because retail traders are really pissed off at me for selling shares to them, and made this promise earlier on that we wouldn't sell shares to them. So what we're going to do instead is we're going to. I was talking to Michael Saylor. I was talking about. Oh, let me interrupt you, Ryan. You were talking to Ryan Cohen? No, you were talking to Michael Saylor. Yes, we have an account with Michael Saylor. I will put the private. But you sure about that? I heard that you had the biggest ever in history. Fund managers withdrew from equities. They withdrew from equities last month. You're super. Don't worry, Ryan. You're buying Bitcoin. We actually like that stuff. We will give you the money. But we will have to dump your stock price by 20%. Oh no, what am I going to do about that? Don't worry, Ryan. Don't worry. We have a solution for you. All you have to do is tweet no at Jim Cramer 24. No! Yes, Ryan. Just like that. No, I can't pretend that it's Jim Cramer that dumped our stock when it's actually. Don't worry, Ryan. This is what to do, Ryan. Thanks, Hal. Speak to you next week. Thanks, Hal. And that's how that story went. So anyway, it was not a great look. People have been asking me about Live Person, and Live Person has a different sort of look to its chart. It's been a little bit happier in the evening time. That's nice. Back at 90 cents. Are we looking for something positive to happen here? Yes, we are. When it happens, do we have an inevitable gloomy feeling in the back of our heads that as soon as it happens, there's going to be a big dump on us from the company? No, we don't have that big fear. Thank goodness. That's a change of pace. Thank goodness. Thank the Lord. So we've had this recent price action. Looks like this on this chart. Last week I spoke about having to come back down here to test, as I explained it all last week, and everything that I explained last week happened. And the analysis from last week was the analysis that's going to take us for the next couple of weeks. So everything happened perfectly from the analysis from last week, and now we're waiting to see if the next stuff can unfold. What I'm looking for here is for a move up towards 121. That's when things start to get quite exciting. The moves above $1 are good, but of course there's going to be a little bit of the kind of resistance from about 104 up to 108 or 9 because of just where the shorts would likely come in at that phase. We'd like to see things pushing past there. It's highly likely that we have It's highly likely that we get a text message in the middle of a sentence and completely forget what the end of the sentence is. If you know what the sentence I was about to say there is, and you have it in your head, then put a comment in the chat box. That might help me remember. So it's highly likely that something happens. I'm sorry, right? So we were talking about 101. Yeah, so up at these price points, it's yeah, there's resistance, right? There's resistance. It was support previously. I think that this is the thing to highlight on the chart in terms of where we are looking over the next wee while, and it's going to be towards the resistance that's formed here at the top. Put that into a kind of a visual picture for you. This would be the top end of what would be the little toppy formation, which has resulted in the downward price action. So if we just take a kind of measuring stick roughly from here, pop it down here, you can see that there was, we spoke about this last week, that the measuring stick, if you exclude that top area, and I know that sounds so kind of dodgy, but that's just because of this, all these wicks, right? You see, so if you actually measure it from the candle bodies itself, and you come up with something like this, which is actually sensible, and you pop it down here, you can see that that's actually what happened. If we did push down further, yeah, of course, we'd be expressing the full volatility of that whole zone down below, the full elasticity. That could happen. People have been informed. But the reason why we're looking at this as resistance, of course, is because of the general shape up here. Where's it say triangle? There's triangle. So this zone here is where this target is. So you can see that's where resistance was, because it was obviously support for me to be able to draw that triangle around it. So this is where resistance is. But that is a really interesting little place for a price to be. I'd be interested if any of you harmonizers out there want to do the measurements for me, right? Because this is a show, a community of traders. And one of you can do the harmonics and post it about it in the room. You'll get kudos from other people who are like, "Oh, that's cool." So what is this? Is there something just here? Wonder. Fairly deep after a 50% retrace. Anyway, I don't actually like using harmonics for like a turnaround sort of thing, and the most important story for me really remains the basic trend line function that we have here. And if you wanted to, like we spoke about before, you could pop this on a linear chart. Spoke about this before, and you can see that this continues to stay intact, unbroken. This line is unbroken. I use logarithmic charts though, and I do appreciate the volatility just here has pushed us outside of a zone. Just real quick, actually, so something I haven't actually done for a wee while, and it occurs to me that I am curious. Anyway, can't be bothered making a new one to fit over that. Right. The thing that I'm looking at there for is, of course, this overall upward channel. I'm aware the volatility around here is broken, as essentially could have broken the logarithmic incline, but the linear one is what I'm actually looking at, especially at lows, which are so low. We're below $1 in price. And if you put this into the context of things, on the big time frame, the reason that you can see the linear chart there, great, or the logarithmic chart, great. Pop it onto linear, and you can see that the whole thing is basically flat along the bottom almost anyway. So when I'm looking at these really, really, really low prices, and you see you have to really, really zoom in so people can see this, then that trend line really does actually start to make a lot more sense and linear from that perspective, right? And that's what I'm mostly looking to. That's my main sort of thrust with the analysis here. To address the guy who I have great sympathy for, that feels kind of like, and shout out to you, pal. Thanks for reaching out in the comment before to talk about it. I actually don't mind. Stretch out. Yeah, so with regards to that, like the whole chat is where we would be looking at in the future as having been a really great buy price. Anything down here could very easily resolve into being like anything down here and anything down here, here. And this isn't necessarily like a bad thing, but obviously as you've got a low price stock that's down there below $1, and it has volatility. People often talk about penny stocks and so on. Now, this isn't a stock that's always been a penny stock. It's actually spent the vast majority of his lifetime priced significantly higher, and there's got an interesting story behind it. One of the things I brought out to talk about in the last week has been UiPath, the ticker PATH. And you can see how it's performed recently here in the chart. Let me put on the daily time frame so you can see a nice string of green at the bottom. See this earnings here? Always beating expectations. Always. And as you look at these going, you can see it growing. Earnings up to 245, 300, 400, down to 300 again, back up above 400. 423, is that the most they've ever earned in a quarter? Yeah, it is. There was one outlier month in the past, or quarter in the past. Sorry, one outlier quarter in the past where they did very, very well and got close to it. But that's the most they've ever done, ever in their history of the company. Here is the chart though, and as you can see, it's been a bit of a bonfire, right? Bit of a bonfire it's been. Okay, and there's huge volatility in around these zones, and it's just trying to say to people, like, there's people out there who will go on about LivePerson's earnings and the decline that they've seen in their earnings and so on, as they understand it's a company that's in a turnaround phase, and they'll try and think to themselves something like, you know, this massive drop down in price is like directly related to like their earnings and things like that. It has been a big direct correlation, but that the story here is 1-to-1, you know, that it's 1-to-1, and that, you know, that you'd need to see positive earnings coming out before this chart starts to go up the way. And it's just like, it's not 1-to-1. That's not how